that last part of the movie in a cycle where, okay, shit, now it's the difference between a depression, right? Then your boss loses his or her job.
Right.
But in a recession, the part where you're losing your job, where never in the history of markets is that a good thing.
Right. And, what's interesting is, I don't know if you saw it, there was I think it was a Harris poll recently of a broad swath of, I don't think it was an investor base for the poll. I think it was just broader individuals, consumers. And it came in at 50-50 in terms of what do you think is the more toxic problem? Would you rather have a recession and have that help bring down inflation, or would you rather avoid a recession even though you'd have to suffer inflation? And it was 50-50.
Really?
So, yeah, which surprised me. But I think, inflation, everybody's inflation is different. We can look at CPI or PPI or PCE and it's a number. Yeah, you can massage it core versus headline, month over month versus year over year. But everybody's individual inflation is quite different.
Right.
My parents who are elderly, they don't drive a car anymore. They live in senior living. It doesn't have significant rent increases. They don't buy food anymore. So what they experience, and they're about to get a huge, COLA adjustment in their Social Security. Their lives around inflation is entirely different than somebody who's got to drive an hour to work every day, and because they can't afford to eat out, are buying food, and they've had to take on a second job like the multiple job holders to make ends meet simply because of the inflation problem. So inflation is, everywhere a monetary phenomenon. It's a personal phenomenon. Do you own a home? Do you rent a home? I mean, the list goes on and on.
Right.
So I think everybody experiences inflation in a very different way. But although I wasn't an investor professional in this business in the 70s, I lived it as a kid, and there's just so little experience with this change. And I think one of the tells, by the way, that we may be in a more sort of secular shift to not something akin to the 70s. I think there are a lot of differences in terms of what were the inflation drivers in the 70s, what the reaction function was, but it is important that for 3 decades, from really the mid 60s to the mid 90s, you had almost the entire period of time, you had a negative correlation between bond yields and stock prices.
Right.
Because that was more of an inflationary backdrop. It wasn't high inflation all the time, but it was a more inflationary backdrop. So typically when bond yields were going up, it was because of a brewing inflation problem without commensurate significant pickup in growth. That's a bad environment for the equity market. Then you had this 2-decade pre-pandemic era where, with very few exceptions, you had a positive correlation between the two. We're back in negative correlation mode. When people ask me, is this a shift to a more inflationary backdrop? I think that's one of the metrics to keep an eye on.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there, subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.